In the latest surveys of economic confidence, British consumers report a net score of -32, a level last seen in the aftermath of the Truss mini-budget. But when it comes to personal financial expectations, there is a positive score of +4. In other words, we expect the economy to be terrible, but for our own financial situation, a net balance of people are actually positive. Now you might well ask, don't people know there's a budget coming up with a possible 22 billion of tax rises? Anyway, now the government try to claim that the UK has had the fastest growth in the G7 during 2025. To be honest, it doesn't prove that much. Last month, monthly growth did pick up from -0.1 to +0.1, something of a nothing really. A more reliable guide, economic growth in the past 3 months, is positive if unspectacular. That's perhaps the kindest way to describe it. But very modest economic growth has done little to shift the vibe that the UK economy is stagnant, broken, or worst case heading for a crisis. Graphs like this from the OBR do lend weight to the more pessimistic doomsday forecasts. But as I often show this graph, we'll look at this in more detail to see how useful it actually is. Now, the negative vibes are related to the wealth of bad news that seems to keep hitting the UK economy. In particular, UK inflation has been the highest in the G7, and recently the IMF increased their expectations of UK inflation in 2025 to an average of 3.4%. This inflation has eroded growth in real pay, reduced confidence, led to higher interest rates than expected, and is also increasing the cost of UK borrowing. Interest payments alone have been a major factor in breaking the Chancellor's forecasts, leading to an estimated shortfall of £22 billion in the upcoming budget. That's a lot of tax rises. And amidst all the talk of an economic doom loop, higher taxes leading to lower growth, which leads to the need for more tax rises, it's not surprising that households are negative about the state of the economy. And worse still, the persistence of inflation is not because the economy is growing strongly, but cost push factors such as rising electricity bills and rising water bills, the kind of thing that really hits living standards. And perhaps more worryingly, at least one member of the Bank of England MPC argued that in a bid to bring down inflation, interest rates are still too high, and this risks pushing the economy into recession. Alan Taylor argues the real problem is not so much inflation, but the downward trajectory in output, evident in the softening labour market and very low business confidence, and also worrying decline in production output, which is 2% down on January 2023. And of course, if growth is slowing down, a tax rising budget may cause even more decline later in the year. But if the economy is in such a bad shape, why do we see a net balance of people, especially young people, actually expecting better for personal finances? Well, there are a few positives. In the past 2 years, real wages have risen. In particular, those workers on the minimum wage have seen wages rise faster than inflation. There's also been a boost to public sector pay. In fact, government spending has proved a significant component of economic growth, although that's going to be lower in coming years. Also, mortgage rates have fallen in the past 3 years from a high of 6% to 4.2%, but has given mortgage holders relatively more disposable income. And tentatively, some sectors report rising consumer demand. New car registrations jumped almost 14% year on year to September. However, the spectre of another tax-raising budget has caused a slowdown in consumer spending recently. Now, a third factor is that in the past few years, we've seen a steady rise in the savings ratio, quite unlike the UK, and it means that households have a much bigger saving buffer than previously. Now, this high saving rate reflects very low confidence and low expectations, but it might account for that dichotomy of better expectations of personal finances, because at least some people have more of a savings buffer. Also, expectations of the economy increasingly reflect political views. Robert Ford, professor of political science, says, if your party is in charge, you say things in the economy are great. If your party is not in charge, then you say things are terrible. The young people who are more likely to support Labour have become more optimistic about the economy since the election. Equally, the older generation who don't really vote Labour are much more pessimistic. Reform voters. Now, I find it really interesting, this dichotomy between economic doomerism and relatively better expectations of personal finance. Certainly, a glance at the media and YouTube, you'll find a wealth of negative stories. There's a saying that if it bleeds, it leads. But for economics, the more doom and gloom, the better the video does. The market for optimism and hope is pretty niche. And with something like economic data, you can of course always find what you want to find. Having said that, you don't have to work too hard or use misleading data to argue the UK economy is actually doing pretty poorly. Even a small improvement in growth this year does little to change the fundamental story of the past 16 years. The big picture is one of economic stagnation and a sharp change from previous decades. And of course, it's not just GDP. People's lived experiences of the economy is reflected by housing, healthcare, basic infrastructure. And it's hard to argue that a deterioration in public services gives a hidden reduction in living standards, not always reflected in GDP data. And also on the subject of real wages, if you wanted to make the case that the UK economy is actually much worse than people realise, well, the outlook for real wage growth is pretty poor. The boost to public sector pay is likely to be a one-off, nominal wage growth is slowing down, and unemployment rising. To some extent, the high real wage growth of the past couple of years was really catching up with a big decline during 2022. And without a big, sustained boost to productivity growth, the scope for rising real wages is very limited going forward. And of course, there is another problem. The Joseph Rowntree Foundation argue that if you take into account housing costs, then disposable income is set to fall in the next 5 years. In fact, it could be the worst parliament for real incomes on record. Also, incomes will fall the most for low-income households who will be £1,000 worse off in a few years. And what about the worst case scenario, that the UK is heading for an economic collapse? Now, if you wanted to make this kind of story, you could point to this forecast for public sector debt, which the OBR warns will start to get out of control. Now, some viewers have commented that this is highly speculative and likely to be overly pessimistic. Now, there are a few points worth making. Firstly, if you look at the forecast, debt barely rises above 100% of GDP until 2040. I actually find this overly optimistic. I think debt will be higher by 2040 because the OBR have consistently underpredicted how much UK debt would rise. And then we always get some black swan event as well, which causes a big rise like COVID or Ukraine war or financial crisis. The main problem, though, is that the OBR have consistently forecast the UK economy is going to grow much faster than it actually has in the past 16 years. Productivity growth has reliably disappointed. In fact, the OBR may eventually be getting around to downgrading their optimistic forecasts, which of course will give the Chancellor a headache of needing more tax revenue. Now, if you do want a crumb of comfort, the Resolution Foundation argue that productivity growth has actually been much better than official stats. They say it could be 1.6% growth in the past year rather than a decline of 0.5%. And they argue that this is because the ONS labour force is so unreliable, which is kind of an ironic way that the economy could be doing better because stats are completely unreliable. But even so, they still expect a productivity downgrade because, again, the bigger picture is this 16 years of pretty poor performance. Now, going back to the graph, after 2050, debt suddenly starts to explode. This is because when you have an ageing population and assuming slower growth, then automatically pension and healthcare spending will rise faster than tax revenues. And when you have a growing budget deficit, debt interest payments start to get bigger and bigger. Then debt is rising just to pay the higher interest payments. And that's when the situation will start to explode out of control. Now, one important assumption of this is the OBR forecast is that the government keep existing tax and spending plans and don't change anything. And of course, this is unrealistic. For example, petrol tax will evaporate over the next 40 years as people switch to electric, but you assume there will be a new tax to replace it. Road pricing, no one really wants to introduce a new tax, but I'd be surprised if nothing happens in the next 40 years. However, having said that, you could argue that in an era of populism, the government is finding it very difficult to reduce spending or increase taxes. The Labour government, huge majority, but been forced into a U-turn on winter fuel, health-related benefits, and there's a kind of a widespread political unwillingness to end the pension triple lock, which is one of the big factors in the long term. So you may argue that this suggests that really any government will be paralysed to introduce new taxes or cut spending. But having said that, I think faced with a potential bond revolt, the UK parliamentary system would make enough budget changes to prevent that kind of spiralling out of control. And certainly the tax burden has actually risen a lot in recent years. People may be complaining, but taxes have gone up a lot. And even if spending seems unstoppable, always hard to take benefits away, but taxes may have to keep rising to keep debt under control. Anyway, if I was in France, I would be actually more sceptical, because they've got a split parliament, no one with a majority, struggling to form a government, and of course nobody wants to be a party to suggest painful cuts or really big tax rises. And in France, the government already spend 57% of GDP. And talking of France, the situation really is pretty grim there. In some respects, there are many similarities with the UK, but actually I would say that France has it much worse. So do watch this video if you kind of want to feel relatively better about the UK economy. At least we're not France. Anyway, thanks for watching. Do subscribe, and there are lots more great videos to come. And let me know what you think in the comments, whether you agree with the kind of surprising, perhaps, optimism of young people about their personal finances. Thanks for watching. See you.